There's a specific number in personal finance that matters more than almost any other number, and almost nobody talks about it correctly. It's not $1 million, and it's not the magic retirement target the financial industry sells you. It's $40,000. And the reason it matters is that $40,000 of liquid cash sitting in a high-yield savings account that you don't touch is the threshold where your financial life genuinely changes character. Below $40,000 in liquid savings, you're playing defense. The 22% APR credit card is your only response to a real emergency. Every job decision is constrained by your need to keep earning, and every market drop feels personal because you can't afford to ride it out. Above $40,000 in liquid savings, you become a different financial person. The decisions you make stop being driven by fear of the next emergency. The traps that catch most people stop catching you. This video is about the rules that get you to that number and what to do with it once you have it. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people, instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that's what you want, hit subscribe. Today, I'm going to walk you through 6 specific rules that govern this $40,000 cash cushion, in roughly the order you should think about them. Some of these rules are going to contradict standard YouTube financial advice. That's intentional. The standard advice is wrong on this specific topic, and the reason it's wrong is that most personal finance content is written by people who've never been one paycheck away from disaster, so they don't understand what cash actually does for the people who need it most. Before I get to the rules, let me explain why $40,000 specifically is the right number, because the precision of the number matters. Per the most recent Bureau of Labor Statistics Consumer Expenditure Survey, released in early 2026, the average US household spends about $6,545 a month on everything: rent or mortgage, food, utilities, insurance, transportation, healthcare, the basic cost of keeping a household running. 6 months of those expenses is about $39,270. Round that up for the buffer of bad luck, and you get $40,000. That's not arbitrary. It's the amount of money that lets you absorb 6 months of complete income disruption without selling investments, taking on debt, or borrowing from family. The $40,000 converts a financial emergency from a life-changing event into an inconvenience that resolves itself. For someone with much lower expenses, the right number might be $25,000. Households with high fixed costs might need $50,000 or $60,000. But for the average viewer of this channel, $40,000 is the threshold. The rules I'm about to give you assume that's roughly your number. Rule 1. The $40,000 lives in cash, not in the market. This is the rule that contradicts most YouTube advice you've heard, so I want to be clear about it from the start. The $40,000 cash cushion is not part of your investment portfolio, not in your 401k, not in index funds, not in any account where the value goes up and down with the market. It sits in a high-yield savings account, currently earning between 4 and 4.35% at the major online HISAs per Bankrate's May 2026 data, and that's where it stays, untouched, until you need it. The reason for this rule is that the entire purpose of the $40,000 is to be available the day a real emergency happens. The market drops 30% in a year about once every decade, and the worst draws happen in years when the rest of the economy is also breaking, which is the same year you're statistically most likely to need the cushion. If your $40,000 was in the S&P 500, you'd be selling it at the bottom to cover an emergency, locking in losses, and abandoning the long-term growth that was supposed to make the risk worth it. The math works against you in exactly the moment you need it most. I know the objection because I had it myself. The opportunity cost of $40,000 in cash earning 4% versus the same money in the market earning 7% feels like leaving $1,200 a year on the table. That feeling is the trap. The 7% figure is a long-term average, not a guarantee in any specific year. The 4% in cash is guaranteed and instantly accessible. You're not paying $1,200 a year of opportunity cost. You're paying $1,200 a year for an insurance policy that lets you never sell investments at the wrong time. That insurance is worth dramatically more than $1,200 over the course of a financial life, because the cost of selling at the bottom of a downturn is measured in tens of thousands of dollars, not in the spread between cash and market returns. Rule 2. Build the $40,000 before you optimize anything else. This is the rule that genuinely contradicts the order of operations most personal finance videos teach. The standard advice goes like this: capture the employer match, then pay off high interest debt, then build a small emergency fund of 3 to 6 months expenses, then max out tax advantaged accounts, then invest the rest. That order is mostly correct, but it has a specific failure mode for people who haven't crossed the $40,000 threshold yet. The failure mode is that maxing out a 401k at $24,500 a year while only having $5,000 in cash is, statistically, the move that produces the largest number of forced sale emergencies for that exact person. The version that actually works is to capture the employer match, eliminate any credit card debt over 15% APR, and then build the $40,000 cash cushion before you do anything else. That includes before you increase your 401k contribution above the match. You'll temporarily contribute less to retirement than the optimal version, and you'll miss some tax advantage growth on the dollars that go into cash instead. The math accepts that loss, because the bigger loss avoided is the forced 401k withdrawal during a job loss, which incurs a 10% penalty plus full income tax. A single forced 401k withdrawal of $20,000 in your 30s cost the saver something like $80,000 to $140,000 of long-term wealth, depending on how many years you had until retirement. The immediate hit is about $6,400 in penalties and taxes. The bigger hit is the lost compounding on the $20,000 itself, which over a 25 to 30 year horizon is worth somewhere between $90,000 and $130,000 of retirement money you'll never have. The cash cushion prevents that scenario from happening at all. The way to build $40,000 in cash if you don't have it is mechanical. You set a savings rate that you can sustain, you route every dollar of those savings to a high yield savings account, and you stop touching it. For someone earning $80,000 a year, saving 15%, the cushion fills in about 3 years and 4 months at zero interest, or closer to 3 years if you account for the HYSA earning 4% along the way. At $50,000 of income with a 12% savings rate, the same cushion takes about 6 years and 8 months without interest, or roughly 6 years with the HYSA helping. Those numbers are slow. They're also real. The mistake most people make is trying to skip the cash build phase by investing instead, which produces a person with $30,000 in retirement accounts and $2,000 in checking, who is one car repair away from a 22% APR credit card balance. The cushion has to come first. Rule 3. Don't touch it for non-emergencies. The $40,000 is for the things that would otherwise destroy you. It is not for opportunities, however good they look, and it is not for vacations, the car deal you can't pass up, or the down payment on a house unless you've already replenished or budgeted separately for that. The reason this rule is so strict is that the cushion only works if it's actually there when you need it, and human beings are extraordinarily good at finding reasons why this particular non-emergency is actually an emergency. I had a conversation with my friend Greg a few years ago. When he was sitting on a $35,000 cash cushion he'd taken 5 years to build. Greg is a mid-career mechanical engineer in his mid-40s, the kind of guy who runs his own numbers and who I'd have bet money would never make a bad financial move. A friend offered him a real estate investment opportunity that couldn't lose, with a projected 25% return over 18 months. Greg pulled $25,000 out of his cushion to participate. 8 months later, the deal failed, the partner disappeared, and Greg was left with $10,000 in cash, a $25,000 hole in his cushion, and a sick parent across the country who needed help paying for unexpected medical costs. The cushion that was supposed to handle his parents' situation was gone, and Greg ended up taking out a personal loan at 11% to cover what the cushion would have covered for free. The opportunity that was supposed to enrich him cost him about $40,000 of compounded financial damage, on top of the $25,000 he lost to the failed deal. The rule is that the cushion is for one specific category of event, which is unexpected expenses or income disruptions that would otherwise force you into high-interest debt. Job loss qualifies, as does a major medical bill or a roof that needs replacing. A real estate opportunity does not qualify, no matter how good it looks, and neither does a great car deal or a vacation. The discipline of keeping the cushion sacred is what makes it work as a cushion at all. Without that discipline, it's just a slush fund, and slush funds don't protect you from the events the cushion is supposed to protect you from. Rule 4. Once you have $40,000, stop adding to it. This rule is for people who have already crossed the threshold, and it's important because overbuilding the cash cushion is a different kind of mistake that costs real, long-term wealth. Past $40,000 in cash, the math reverses. The opportunity cost of additional cash starts to outweigh the insurance value, because the insurance value tops out at about 6 months of expenses for most households. A $60,000 cash cushion isn't meaningfully more protective than a $40,000 cash cushion for someone with average expenses. It's just $20,000 of money sitting in a 4% account when it could be in an account compounding at the long-term market average. The next dollar past $40,000 should be invested, not stored in cash. That means raising the 401k contribution toward the maximum, funding the Roth IRA, opening a taxable brokerage if those are full. The cash cushion is a one-time build. Once you have it, you maintain it at $40,000, accounting for replenishment after any draws, and you direct new savings toward investments that actually compound. The version of this mistake I see most often is someone who built the cushion through a long period of fear and never trusts the math enough to stop. They've got $80,000 in cash earning 4%, and they're nervous about putting any of it in the market because the cash feels safer. The cash isn't safer in the long run. It's losing roughly 3% per year to inflation, while only earning 4% in nominal terms, which works out to about 1% real return, versus 7% real returns in a diversified market portfolio over the long term. The opportunity cost on just the excess $40,000 you're holding past the threshold over 20 years is roughly $100,000 of wealth that quietly evaporates. Money that could have been compounding in the market, but instead sat earning 1% real in cash. The cushion is worth $40,000. The over cushion is worth nothing. Rule 5. Replenish within 6 months of any draw. The cushion is going to get used. That's its job. The rule about using it is that the moment you draw from it, the new top financial priority is to replenish it before any other discretionary financial move. Not before next month's rent, before the next vacation, the next non-essential purchase, the next investment increase, the next anything that isn't a basic need or already committed obligation. The replenishment becomes the savings goal for whatever number of months it takes to restore the full $40,000. The reason for the 6-month window is that the second emergency tends to come faster than people expect. The same year you have a major car repair is statistically more likely to be the year you also have an unexpected medical bill, or the year your spouse loses their job, or the year a parent needs financial help. Emergencies cluster. The cushion that was sized for one emergency at a time fails the moment 2 arrive in the same year, which happens more often than you'd think. Replenishing within 6 months keeps the cushion in working order for the realistic scenario where bad things happen in groups. The discipline of replenishment is also what separates people who actually use the system from people who treat it as a one-time achievement. The cushion that was built once and then slowly drained over 5 years to fund discretionary spending is exactly the same as not having a cushion. Replenishment is the maintenance that keeps the system functional. Skip it once, and the system slowly stops being a system. Rule 6. The cushion changes your relationship with your job. This is the rule that nobody warns you about, and it's the most valuable side effect of the entire $40,000 framework. Before you have the cushion, your job has a power over you that you may not even be conscious of. Every decision at work is filtered through what happens to me if I lose this job. And the answer is usually some version of everything falls apart. That filter changes how you negotiate, how you push back, how you respond when something feels wrong. It usually makes you compliant in ways that are bad for your long-term career and bad for your dignity. After you cross $40,000 in cash, that filter quietly disappears. You realize, almost without noticing, that you could quit this job tomorrow and survive for 6 months while finding a better one. You can refuse a project that's outside your role, ask for the raise without sounding desperate, or leave a manager who's making your life miserable. The cushion isn't escape velocity for your career. It's just enough oxygen that you stop accepting bad terms because you're afraid of the alternative. The improvement in career outcomes for people who cross this threshold is real and measurable. They get bigger raises and better promotions, they leave bad jobs faster, and the cumulative effect over a working life is dramatic. The reason this works is that desperation is something employers can detect. The candidate who can walk away gets the better offer. The employee who isn't afraid of losing the job gets the raise that the desperate one doesn't. None of this requires you to be aggressive or to change your personality. It requires you to genuinely have options, which the $40,000 cushion creates by making your basic survival not dependent on this specific paycheck. What to do with this video? If you have less than $40,000 in liquid savings right now, the action item from this video is to start building toward that number this paycheck in a high-yield savings account that's separate from your everyday checking. The number is going to take longer to build than you want, and that's okay. The fact that you're building it at all puts you ahead of most US households. Per the Federal Reserve's most recent survey of household economics and decision-making, released in May 2025, 37% of US adults can't cover a $400 emergency from cash savings, and only 55% of adults have set aside enough money to cover 3 months of expenses. Crossing $40,000 puts you in roughly the top quarter of households for emergency preparedness, which is a position most people never reach. If you already have $40,000 in liquid savings, the action item is to stop building it and start investing the next dollar instead. Run the calculation on whether you've quietly gone past the right number into an over-cushioned position that's costing you long-term wealth. At $80,000 or more in cash, with a stable income and a normal financial situation, you're probably keeping too much in cash and should redirect some of it to your 401k, Roth IRA, or taxable brokerage. For everyone in between, the action item is to know exactly where you are. Sit down this weekend, calculate your liquid savings on a single sheet of paper, and decide whether the next 12 months should be focused on building the cushion or moving past it. Either answer is correct, depending on your specific number. The wrong answer is not knowing. Drop a comment with your current liquid savings range and which of the 6 rules feels most relevant to where you are. I read every comment and I'll reply to as many as I can. And if you want me to walk through how to structure your liquid savings to maximize the rate without compromising access, including the trade-offs between high-yield savings accounts, money market funds, and short-term treasury options, hit subscribe because that's the next video. I'll see you in the next one.